SMF, welcome to the VIX, VIX.X. And what is the volatility index? The volatility index is a fear indicator. And basically, when equities are selling off, the VIX goes higher, and when people are in rally mode, the VIX goes lower. The lower that the VIX goes, the more complacent that people get, the more relaxed that people are with the markets, and generally the lower that number gets, we're going to set up and have a reversal on the NASDAQ 100 and the S&P 500. And basically what we're going to look at is a directional movement of that contracts that we have done right here. We have 20s all the way up to 30s, even 30 puts and 30 calls, 25 puts, and so forth. So basically right now we're going to deal with the key Pacific contract is the 2250 put and the 2250 call. So basically we had a big breakout here on the 2250 put, because what was happening at the time, the VIX was not performing in the right direction, so this direction went mathematically higher, and this mathematically direction went lower. And basically when the VIX is breaking down, the calls are going to go down in value and the puts are going to rise. The 2250 put will rise in value, the opposite. So basically, if the VIX was to fall, continuously fall, the contract value will go lower on this call side. It'll go down in value. And this, well, side will break up in value. The thing that we're going to get to a point where that when you break out here, this is what we're looking for right over here. This was a breakout. So this breakout right here occurred on 426 when we called the top of the market. Go to stockmarketpending.com, look at April 25th index videos, you'll see it there. When that thing broke up higher, stock markets went down. But then when stock markets rallied, the calls lost their value. And not only that, they're at a lower value than they were over here at $4.17 and a low of $4. Now, this very call is coming down to the SMF wholesale bid in value. So when markets do reverse, when those trends start to set up, right now we're in a nice bull trend, but when we have that topping reversal, then we're going to start transacting these trades accordingly and right on the money. And basically here is the 2250 call. That's up here. And I want you to know on the other side of it is the 2250 put. And you can see where the 2250 puts, they were very cheap. Let's do the pricing on those. So when the stock market rallied, you could have purchased these down here as a volatility trade to protect your, if you were short, say you were short to market and you didn't know what you were doing. You went right over here, bought 50 of these contracts or whatever you could buy. Say you paid, you know, the low was 15 cents and the high was $1.15. So let's say you made 80 cents here on 50 of these contracts at 20 cents. Well, you made a big profit by having that volatility trade up. So when the bears are trying to short the market, when the bears are staying short too long, they need to buy that side of the market to protect their positions. Now on the other hand, MMTs, the opposite would occur over here. If I am long the market, then I am making money on the breakout of the markets, and these are going down in value. So when you had the big breakouts, you had big breakouts. It helps you figure out what these contracts are going to go to. I'm going to set the prices for the call with you off of the video. I'm also going to set the current put prices, and basically we'll go over some of the other call and strike prices within the VIX.